All right, let's just dive right in. The market is, well, it's a mess right now, thanks to a global crisis. And it's putting even the most stable, most, boring household stocks to the ultimate test. Today, we're going to figure out what happens when these massive geopolitical shocks ripple through your portfolio. And we're going to ask a really critical question about a company that's famous for being reliable. Can Clorox actually weather this storm? So here's the plan. We'll start with the big picture, the energy shock that's got the market on the ropes. Then we'll see how that's squeezing whole industries. From there, we'll zoom right in on Clorox to see how a so-called defensive stock holds up. And finally, we'll pull it all together and figure out if it's a safe harbor or a value trap. Okay, so first, let's set the stage. Right now, the entire global market is being defined by one single massive event: the conflict in the Middle East. And let me be clear, this isn't just some regional problem. It is causing an absolutely unprecedented disruption to the world's energy supply. Look, the International Energy Agency is not known for hyperbole. So when an organization like the IEA says this is the largest supply disruption in history, you know the situation is serious. The closure of the Strait of Hormuz has basically just turned off a major tap for global oil, and that has created a crisis like we have never seen before. Now, just look at these numbers. The speed here is what's truly staggering. In one single month, we saw Brent crude, that's the global benchmark, spike over 55%. Naphtha, a key ingredient for basically all plastics, jumped 60%. And for the average person, this meant real pain at the pump. Petrol prices in the UK shot up a record 20 pence per litre. This isn't just a headline, it's a shockwave that's hitting the entire value chain hard. So, no surprise, this has triggered absolute chaos in the markets. The S&P 500 is tumbling as investors start pricing in a serious recession risk. And we're seeing that classic flight to quality, when everyone gets nervous and yanks their money out of stocks, pouring it into safer bets like gold or government bonds. It really begs the question, can any stock truly be a safe haven in an environment like this? And that brings us right to our next point, the squeeze on industry. Because this crisis, it goes so much further than just the price of gas. The ripple effects are being felt everywhere, in places you might not even think about. Think about it. Higher energy costs bleed into literally everything. Moving goods around gets way more expensive, which drives up the price of everything you see on a store shelf. Fertilizer production, incredibly energy intensive. So a 40% price spike there is a direct threat to the global food supply. And those petrochemicals we talked about, they're the basic building blocks for plastics. That means the cost to make everything from a water bottle to a car bumper is just skyrocketing. And this is a really critical point for our story. The chemical sector is in a particularly nasty spot. It's getting hit with a double whammy. Not only are its electricity costs to run the factories going through the roof, but the actual raw materials it needs to make stuff, the hydrocarbons themselves, are also surging in price. This puts an immense, almost unbearable pressure on their profit margins. So this is the exact moment when investors start desperately searching for some kind of stability. And that search for a safe harbor brings us right to the heart of our analysis today, the household name, the Clorox Company. Now, in chaotic times like these, a lot of people run to what we call defensive stocks. These are the companies selling things we all need, no matter what. Cleaning supplies, toothpaste, basic foods. The idea is that their sales and hopefully their stock prices should hold up better than most. But the question is that theory actually holding up right now? Well, here's the twist. Clorox isn't exactly coming into this crisis from a position of perfect strength. The company's been fighting its own battles. You can see here, first, a disruptive cyber attack, then a massive and very difficult overhaul of its internal software, an ERP system. Now, anyone in business knows that rolling out a new system like that is a nightmare. And for Clorox, it actually led to a 19% drop in sales in a single quarter because they couldn't ship products properly. Ouch. Okay, so with that backdrop, a global crisis on the outside and these internal struggles, let's drill down into the single biggest reason investors own this stock, that dividend. And I mean, you can't argue with this track record. It's incredible. Clorox is a dividend aristocrat, which means it has raised its dividend for 48 straight years. Just 2 more years and it'll earn the legendary title of Dividend King, a club reserved for companies with over 50 consecutive years of dividend growth. This history is exactly what income investors drool over. But this slide, this perfectly illustrates the central dilemma. Investors are getting a massive 4.9% dividend yield from Clorox. That's way higher than its competitor Church & Dwight. But, and this is a huge but, that reward comes with a ton of risk. Clorox's payout ratio is about 80%. That means for every dollar of profit it earns, 80 cents is going right back out the door to shareholders. That leaves almost no wiggle room for error, especially when your profits are getting squeezed. Church & Dwight's dividend is smaller, sure, but its 40% payout is so much safer and more sustainable. And on top of the dividend pressure, there are other risks. Check this out, a huge concentration risk. More than a quarter of all of Clorox's sales go to one single customer, Walmart. Now think about that. Any change in that relationship or any pressure Walmart decides to put on its suppliers to cut costs could have a massive, outsized impact on Clorox's bottom line. So here's the bottom line. The company is getting hit from all sides. You've got soaring energy and transport costs crushing their margins from the outside. You've got the high dividend payout raising serious questions. Internally, they're still recovering from that messy system rollout. And to top it all off, they've taken on more debt to buy Gojo, the maker of Purell. It's just a perfect storm of challenges. Which brings us to the final and most important question. How on earth is an investor supposed to read this situation? Is this a golden opportunity to buy a fantastic company while it's down? Or is this a classic value trap waiting to spring? All right, let's break down the two sides of the argument. The bulls, the optimists, they see a future dividend king that's trading at a discount to its peers. They think once Clorox gets past these ERP issues, the company is a coiled spring just waiting to bounce back. But the bears, they see way too many red flags right now. That sky-high payout ratio, the crushing margin pressure from energy, more debt, and technical charts that are basically screaming strong sell. And this quote from Zacks really just says it all, doesn't it? This whole situation is on a knife's edge. This stock's future might depend entirely on how long this conflict and the energy crisis lasts. If it ends quickly, buying now could look genius. But if it drags on, this could be a very painful value trap. So as we wrap this up, the real takeaway is that Clorox is the perfect case study for the dilemma every investor is facing today. It forces you to decide what you value more, the promise of a high-yield, defensive company with a legendary history, or the very real risk that even the most reliable giants can be strained their breaking point by a global crisis. So I'll leave you with this. Is that high dividend a reward for your patience, or is it a warning of the risk to come? That really is the billion-dollar question.